Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for an outlook on fixed income and market risks to watch is Dave Albrycht, President and CIO of Newfleet Asset Management. Dave, it's great to meet with you. Welcome to Trade Talks.
Thank you very much, and thanks for having me.
Let's talk about the macro environment. What are you seeing there in terms of risk?
First, I'd start off with the virus. I break it into two components. We have obviously the science, which has been addressed by Pfizer, Moderna, AstraZeneca with the vaccine, and even on the treatment side, we have Regeneron. Now it's the logistics, and we actually saw just today the problems that Pfizer ran into. They promised a certain amount of delivery by the end of the year, and now they're only going to be able to produce half of that because of supply chain disruption. So I think the market has really said that the vaccine has solved a lot of problems because you've seen a massive rally in risk assets, but I just say that's something you should watch very, very closely. I'd also throw on there's some fiscal cliffs that we are going to run into. We have the student loan expiration of forbearance, which is on December 31st, mortgage forbearance, eviction from rentals, and then unemployment insurance. Can't forget what's going to go on in Georgia. So on January 5th, we have the runoff for the 2 Senate seats, which now looks like it's head-to-head. Are we going to have gridlock? Are we going to have a blue wave? We'll have to wait and see. And then on the economic front, I would just say that, you have earnings releases, which have been ambiguous at best, but coming out better than anticipated. And then economic releases, pretty much the same, coming out better than anticipated. So I think all in all, it's been a good time to have risk on. It's been a good time to, absolutely be very diversified in your portfolio.
Let's discuss the fixed income market specifically. What are the risks investors should be aware of?
Yeah, I would say that the easy beta has been made, right? You've had a big move in the markets, and now valuations are near their 5 and 10-year historical levels, but still a multiple of treasuries. And also, I'd put in the context, you still have 17.2 trillion of negative rates around the world. I think it comes down to sector selection top down, issue selection bottom up, doing your own fundamental analysis. And really, I'm a little worried about passive investing. If I look at, I want to be in active investing. Reason being, I want to know the risks that I have. I don't want to buy a portfolio. We'll say, a high yield ETF or the loan ETF, where we don't like 50% of the credits, and they actually have credits in those portfolios, irrespective of their COVID or energy exposure, what the actual risks are, and they don't even look at valuations. So I really believe that active versus passive, and really getting your hands around what you own, understanding the risk of your portfolio after the easy beta has been made.
Yeah, Dave, both equity and fixed income managers have been saying the same thing, that it certainly is the time for active. Do you expect Fed and central bank policy to remain accommodative, and what's the impact to interest rates?
I would just say that the Fed is definitely going to be remain on hold. They're definitely going to be accommodative. Rates, at least short rates, policy rates are going to remain low. One thing that we did see was we have seen a pretty big move in the 10-year Treasury. You're starting to see the Treasury move up. The 10-year got as low as 57 basis points. Today we're at 97 beeps, so big move. Our range next year on the 10-year is probably 1 to 1.5. So you have to be concerned with duration, obviously, because as rates go up, you get impacted by duration. If you're in something like the ag, where you have a 6-year duration and only a 1% coupon, it can be painful, even if rates only go up 50 basis points in the 10-year. So you have to really, watch what's going on. I think that the Fed will remain accommodative without question. And then the big question is what happens on the fiscal front? Do we get some action prior to the end of December, or do we have to wait till February?
And looking ahead to 2021, where are the current opportunities within fixed income? Which sectors look the most attractive?
So I would say, first, we like the corporate bond market, the IG market, specifically triple Bs. But when you get the short investment grade corporates, you have a very good opportunity to go out of index, off the run asset-backed securities, because the consumer's in such good shape, flush with cash. So subprime auto, franchise lease receivable deals, where you actually get a nice pickup in yield, is a good way to diversify. Agency mortgage backs, right now, current coupons trade at 107. We all know what's going on in the mortgage market, right? Everybody and their brother's refinancing, and you get your money back at par. So if you're at 107, get your money back at par, you have a negative yield. That's not attractive. The non-agency space, the jumbo mortgages, you actually pick up some yield, much less interest rate sensitive. So we like that space. I throw out in the leverage finance space, high yield and bank loans still make sense. Bank loans are one of the few asset classes in fixed income where you actually can buy assets at a discount. All right, so you're buying assets there at about 95. You have positive event risk. SPACs will take you out at par. IPOs take you out at par. Refinancings will take you out at par. And then there's a lot of high yield bond issuance to take out loans. So a lot of positive event risk in the loan market. And then I would also throw out in emerging markets, which we like. IG has been the place to be. That's where you got your best performance. But right now, we like the high yield space. So Sub-Saharan Africa, some of the high yielding assets that have underperformed, in Latin America. Then lastly, taxable equivalent yields are very attractive. Your taxes are definitely going up. So we do like the muni market, but watch out, especially for those with large pension obligations, problems like New Jersey, Connecticut, Rhode Island, Kentucky, Pennsylvania, Illinois. Know your credits, active versus passive in the municipal market.
All right, Dave, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.